Millions of retail traders map their risk against historical support lines, entirely blind to the underlying mechanical forces that dictate where price actually moves. They are trying to navigate a landscape controlled by billions of dollars of institutional liquidity they cannot see. The prevailing methodology relies heavily on moving averages and oscillators, indicators that are simply lagging mathematical derivatives of past prices. They tell you where the market has been, but they provide zero deterministic insight into where large-scale capital is mathematically forced to act next. To understand price action, we have to look at the counterparties absorbing the risk. Historically, market makers on the Chicago Mercantile Exchange provided the liquidity for every retail options contract bought or sold. Modern market movement is severely constrained by the strict hedging requirements of these institutional market makers. Their daily survival depends on remaining market neutral, creating a deterministic, mechanical reality on the underlying asset. When a participant buys a call option, the dealer takes the short side. To eliminate their directional risk, the dealer immediately buys the underlying futures contract linearly based on the option's delta. As the spot price fluctuates, dealers must continuously buy and sell underlying futures to recalibrate their neutral stance. This is the AurumGamma V11 dashboard. It acts as a quantitative topographical map, transforming invisible algorithmic dealer obligations into tradable boundaries called structural gamma levels. It ingests CME options data, applying a 1E-9 divisor, mapping institutional futures liquidity directly onto the standard XAU-USD spot chart. We are going to open the hood of the V11 engine. We will look past the interface and deconstruct the exact quantitative pipeline that calculates these structural constraints. Trading a standard chart without quantifying localized concentrations of dealer gamma is the equivalent of trying to navigate a three-dimensional market with a two-dimensional map. The previous architecture relied on end-of-day settlements. V11 discards those dependencies to establish a strictly live-first data orchestration, reacting instantly to intraday positioning shifts. The engine prioritizes the interactive broker's client portal gateway, operating on port 5000. It pulls a real-time stream of open interest, volume, and spot data directly from the live institutional order books. Building this for gold introduces a specific symbology challenge. The system has to accurately map the active front-month underlying COMEX futures, like GCM26, to their corresponding standard monthly OG option trading classes. This introduces an immediate constraint: strike density. An OG options chain routinely carries over 1,200 individual strikes. Ingesting and evaluating that volume continuously creates massive data bottlenecks. This back-end data flow chart illustrates our memory-efficient streaming pipeline. By utilizing a continuous Axios response stream piped directly into a node readline interface, the engine parses these massive JSON option chains line by line. This avoids storing the entire payload in RAM, eliminating heap overflows and string parsing errors. By streaming rather than batch loading, the dashboard remains responsive even during high volatility events when the option chains physically expand by hundreds of strikes. Because institutional dealers trade futures and retail traders trade spot, the prices diverge. The engine calculates an algorithmic cost of carry spread, automatically syncing the exact futures liquidity zones down to the localized retail spot price. A quantitative model is only as robust as its inputs. Establishing a high-resolution, memory-safe data ingestion layer is the prerequisite for the deterministic math. Once the raw data is secure, it feeds into an isolated mathematical engine executing standard Black-Scholes-Merton analytics across tens of thousands of options contracts every pulse. The engine computes the absolute dollar gamma exposure, or GEX. It derives this by multiplying the option-specific gamma by the localized open interest and scaling it against the square of the current spot price. Processing the entire chain is computationally wasteful. The engine isolates a 3 sigma expected move derived from historical volatility structures, instantly fencing out deep out-of-the-money options to eliminate retail noise. Within that fenced zone, the logic arrays trace the highest local concentrations of GEX. These clusters define the call wall and the put wall, the absolute hardest institutional resistance and support bands on the board. Between those walls lies the single most critical structural marker, the gamma flip. This is the exact transition boundary where aggregate dealer exposure inverts from net long gamma to net short gamma. Standard models often fail to find this point because adjacent strikes can have near-identical GEX values, a phenomenon called strike ghosting. To solve this, the phase 93 logic iterates through the entire sorted profile, summing the total exposure at every level to create a cumulative gamma curve. By identifying where that cumulative sum flips from positive to negative, the engine can apply linear interpolation. This finds the precise decimal price of the transition, instead of simply snapping to the nearest whole strike. If unidirectional volume floods the market, say massive put buying with almost zero call interest, a zero cross logically ceases to exist. The system automatically engages the gamma valley defense, scanning for the absolute mathematical minimum of dealer exposure intensity to act as the localized floor. These calculations do not forecast future events. They map the exact current mechanical parameters where market maker hedging behavior is forced to change. That gamma flip line physically divides the price action into two distinct operational regimes, each defined by an opposite set of mechanical behaviors. When price remains above the flip, the market operates in a positive gamma regime. Here, dealers are structurally obligated to buy weakness and sell strength to maintain their neutral books. This opposing flow compresses volatility. Market makers absorb the momentum, forcing the asset to mean revert heavily off the structural walls and creating a range-bound environment. If price drops below the flip, the math inverts. We enter the negative gamma regime. Dealers are now mechanically forced to sell weakness and buy strength. In this environment, liquidity completely evaporates. Because the dealers are trading in the same direction as the prevailing trend, they accelerate the price drop, chasing the market lower to hedge their expanding risk. This is a mechanical capitulation, known as a gamma squeeze. When price clears the dealer support boundary, the resulting forced liquidation triggers outsized price expansions. The gamma flip is the primary structural pivot because it defines the exact polarity of institutional hedging, shifting market makers from volatility suppressors to volatility accelerators. The macro structure dictates the broader monthly trends, but it is too slow for intraday scalpers. Liquidity sweeps inside the daily session are controlled by 0 days to expiration, or 0 DTE options, requiring a dedicated processing engine. This mathematical graph illustrates the infinity trap. In a standard Black-Scholes model, as the time to expiration approaches 0, the denominator shrinks. The standard formula breaks down, causing the gamma output to spike vertically toward infinity. To maintain structural integrity on 0 DTE T-tax, the V11 engine isolates this failure point. Watch how this spike is replaced by a smooth S-curve. We implemented a delta transition logistic decay algorithm to tame the infinity value and model true intraday hedging sensitivity. This scalar is strictly locked. It only deploys during the final 15 minutes of the trading session to accurately calculate how rapidly dealer liquidity evaporates right before the closing bell. The resulting net gamma output is then scaled by a 2.0x institutional constraint factor, correcting the weights to match the hyper-aggressive hedging pressure localized to 0 DTE contracts. Standard equations produce flawed intraday boundaries. Without the logistic decay transition, mapping 0-day structure is mathematically invalid. This close-up of the matrix radar interface shows the diagnostic layer of the engine. It continuously tracks the gamma slope, calculating the mathematical derivative of the entire GEX profile to map dealer positioning shifts. By tracking the steepness of the reaction curve, the radar identifies exactly when the institutional bid is increasing in density and exactly when dealers are abandoning their support zones. It isolates the difference between a structurally sound, range-bound market and an algorithmic breakdown where market makers are mathematically forced into a squeeze capitulation. Technical indicators guess at market psychology using past prices. The V11 engine calculates absolute structural constraints using real-time deterministic math. Access to 0 DTE logic and volumetric decay scalars separates retail speculation from institutional-grade flow execution. You are tracking the exact zones where the largest participants must deploy capital. You do not need to trade the lagging derivatives of the past. You can trade the raw mathematical realities of the present. In modern derivatives markets, the invisible structural liquidity dictates the trend. The matrix is the mapped reality of the